All right. Despite the pandemic raging on, the appetite for companies to do big deals this year hasn't waned. And while that has played out, folks, upstarts across many industries have used the red hot SPAC market to fetch some majorly high valuations. Let's see if these trends will continue in 2021, though. Victor Nesi is Stifel's co-president and heads the firm's institutional group. Victor, always good to speak with you here. So how sustainable is what we're seeing in the traditional IPO market and with the SPACs in 2021?
Well, Brian, first let me say happy holidays to you, and hope your holiday has been a good one for you and your families and all your viewers. And to my Stifel colleagues out there, I just want to thank them for the effort that they've put in this year. It's been a tremendous strain on the entire organization, but we've come through very, very well. So I think your question is really an intriguing one as we see what's happening in the marketplace. If we take it in a couple of steps, let's first talk about the equity markets. The equity markets this year, based on number of deals, are up almost 53%. Based on volume, that's almost 100%. And in the fourth quarter, that trend has accelerated. What we've seen is that that by volume, that's up almost 200%. And by number of deals, that's up almost 60%. So what we're seeing is that you have this tremendous appetite in the market for equity transactions. As it relates to IPOs, it has really been one of the largest years on record. We saw over 215 deals done this year, about $80 billion raised over the course of the year. That's up about 65%. What's interesting is that in that marketplace, in the IPO marketplace, what you've seen is that health, care, and tech have really been 75% of that market, with healthcare and tech accounting for that large a percentage. What you see is not only these very large transactions, but also the small and mid-cap transactions, which are really the Stifel's bread and butter. And we have had a record year as it relates to that. So the classic equity IPO market and equities overall, not only has there been a large volume, but one of the reasons why there's been a large volume is because how well they've performed. IPOs are up 70%. Actually, on Yahoo Finance this morning, a stat which I agree with, which is that not only are they up 70%, but even if you bought at the end of the first day's close, i.e. you missed that first day pop, you'd still be up almost 30%, which is, roughly, if you say the S&P has been up about 15, it's really been a very good marketplace to invest in. So the classic equity market plays have been working very well. And we see that continuing into the new year with our backlogs and the street's backlogs still very strong. The next statement, though, refers to SPACs, and we can spend a lot of time talking about that if you'd like.
Victor, it's Julie here. I do want to pick up on that point because I'm curious, when we look ahead to 2021, how you sort of expect the breakdown in trends to continue. I mean, this year, as we've talked a lot about, does feel like the year of the SPAC, and we've had a lot of hot IPOs as well. It's been a big year for IPOs. It hasn't felt as busy when it comes to more traditional M&A. Does that shift going into next year? I mean, especially with valuations where they are we going to see strategic deals at these prices?
Julie, that's a great question. Because really, if you think about what's happened in the SPAC market, we'll talk a minute about that. There's been an unbelievable surge in pricings and raisings of SPACs. So SPACs, really, when you talk about it, you have to break it into like three separate categories. It's the formation of the SPAC, i.e. when the SPAC itself, through a sponsor, does its IPO. There's the de-SPACing process, which is the merger of that SPAC into a private entity, bringing that private entity public. And then there's a PIPE transaction where long investors, hedge funds, et cetera, invest into that SPAC and into that new company through after the deal has been announced. All three of those things have been working this year. So what you saw was almost $80 billion raised in SPACs this year. That's roughly 5 times the amount that was raised last year. So to give you a sense of how much money has been raised, why is that? You've got high quality sponsors who are backing these SPACs and bringing them to market, as well as repeat issuers. As they work, as the mergers work, you see repeat issuers because people understand, oh, if I invest with them now, I might see a pop later. In the de-SPACing process, what you've seen is roughly, there's been roughly 47 or 48 SPACs which have now de-SPACs and had that completed, as well as another 50, high 50s, which have been announced. Another one announced this morning, by the way, our client, FinTech 4, merging with Perella Weinberg, bringing them public, deal we're very proud to be a part of. But anyway, there are roughly high 50s transactions that have been announced but aren't yet closed. And almost all of those are seeing an increase in their price. So they are working in the market. Investors are liking what they are seeing. How does it drive the M&A market? Well, there are roughly 230 SPACs sitting out there with over $75 billion in trust. So that means they got $75 billion to put to work. Usually when you think about a SPAC, it's roughly 3 or 4 times that amount is the buying power associated with it. There's almost $250 billion available in the SPACs to do M&A. So what do you have? What drives M&A volume? Well, M&A volumes this year have been down in the US roughly percent or so. Fourth quarter, same trend line, up 62% over the previous year. So what does that mean? What it means is we're seeing quite a bit of an aggressive move into the M&A market. Because why? Well, when you think about M&A, about it in 2 ways. One, what's it mean for the investment banks like Stifel? Well, what it means is obviously more fees. We drive a lot of business off of it. And it's been beneficial as you see that trend line and the acceleration. And, we're one of the largest M&A players, certainly in the marketplace based on number of deals under $1 billion, things of that nature. But additionally, what you end up seeing is that for companies, what do you need for you to want to go to market? To sell high prices, ready access to capital. Debt markets are very friendly right now. Equity markets are quite friendly right now. So we see that trend line continuing. We've seen it once again in technology. It's been very strong here towards year end. I think a little bit of that is cap gains change potentially. But in what you're seeing is somewhat of a rotation back into financial institutions, in which we're also quite strong. So I think the M&A market is looking good into the future, and our backlog is quite strong.
Victor, if we could maybe move off, capital market backdrop, obviously very strong. I'm curious what you see in the fundamentals maybe of some of the companies that you're talking to, working with, because there's a big story in the Journal a couple of days ago. I think the FT ran one a couple of weeks back about the K-shaped recovery in corporate America. And you outlined how you guys kind of sit in the middle of the K, if you will. I mean, certainly towards the top end, but you have a very interesting position in the size of businesses that you're working with. What are you seeing on that kind of backdrop, and how different is it than you thought it might be if we had this conversation in April or May?
Well, yeah, 2 real interesting questions, Miles. If we had the conversation back in April and May with COVID having hit, you would have said what happened in the marketplace back then, and some of the plans we were making and what you saw happening in the marketplace in relation to what actually has occurred as you've gotten through the year. I think I would not have bet on it, right? Certainly not. But to your point, K-based recovery and those types of analyses, we do sit in an interesting spot. First of all, we obviously have benefited from the market's volatility in our equities and our fixed income business. The volumes have increased, and therefore we've seen an increase in that based on the investments that we've made in the past. But in addition, we've seen the benefits associated with what we have built out over the course of the past decade from an M&A perspective, equity underwriting perspective, et cetera. So from our own core business perspective, we are performing quite well, seeing the benefits of our investments. As it relates to our clients and what's happening with our clients, you are correct in that there are certain sections of the economy and industries who have been significantly impacted by COVID and the pandemic and the shutdowns. And people are still hurting in those industries, the service industries, whether that be restaurants or retail or business services. We're still seeing an impact in those businesses. We've seen some recapitalizations, but we're seeing some pain as well. I'm seeing a good amount of pain. Now, interestingly, I would tell you that I'm a big believer in American capitalism, right? And entrepreneurship. And what you're also seeing are new types of companies who are forming around what this acceleration that the pandemic has caused with technology and otherwise, for new types of businesses that are starting up and that are having tremendous success. That's not only the big ones like the Zooms of the world and the things that you see, but also smaller businesses and entrepreneurial businesses that are starting up in the restaurant space and elsewhere. We see things like that. And we are at the forefront of being able to bring those companies capital and then bring them to market. So I'm confident and we're confident about it. That's not to say that there isn't a lot of pain. There is definitely a lot of pain, things that we hope that the economy continues to improve to help those people, and that the government continues to do what it's supposed to do on fiscal stimulus and otherwise.
Yeah, let's hope things get better in 2021, and we'll be sure to have you back. Victor Nesi, Stifel co-president and head of the firm's Institutional Group. Always good to speak with you. Happy New Year. We'll talk to you soon.
Brian and team, Happy New Year to you. And I appreciate you having me on, and have a good and safe holiday and a good and safe 2021.